Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Daniel Lacalle. He's a Spanish economist. He's the chief economist at Tressis and the author of several books, including Escape from the Central Bank Trap. And he's also done work in energy and finance sectors, more than 24 years experience in those sectors in North Africa, Latin America, and the Middle East. And he's also the president of Mises Institute in Spain. Welcome, Daniel.
Good. Thank you, Richard. Thanks for having me.
Great. We thought today we'd talk about an interesting article that you wrote recently, and that is on the nationalization by central banks of the economy. So this sort of applies in general. A lot of central banks appear to be doing this, so it applies to different economies. First, your general thoughts?
Well, the first is we're living in probably one of the most incredible moments in history in terms of monetary policy. We have seen all sorts of monetary policy globally, but I think this is the first time ever in which central banks are issuing so much credit, i.e. print what we call printing money, increasing money supply. We're talking about more than 200 billion a month globally, and there's no recession, there's no crisis. It's not because there is a big turmoil in financial markets. So one of the risks that we're seeing is that the entire economy is so dependent on central banks lowering rates and increasing money supply that it's close to what I mentioned in that article, which is the risk of nationalization from central banks. Think about Japan. The Japanese central bank currently owns about 60% of the ETFs of the country, the equity traded funds. So, that is one of the reasons why I wrote that article.
And also, Bank of Japan is a top 10 shareholder in 90% of the Nikkei, I think also,
Yeah.
Right, you mentioned. So that's just fascinating. You list a number of fascinating facts as well, in terms of like the ECB and the Bank of Japan balance sheets exceed 35% and 70% of their GDP. The Federal Reserve owns more than 14% of the U.S. total public debt. The ECB owns 9.2% of the European corporate bond market and more than 10% of the main European countries' total sovereign debt. So these are some fascinating facts. So what is the driving force of this? Is it the need by central banks to implement their monetary policies, and what's driving that?
Well, I think that at the forefront of all of this is the endless quest from central banks to create inflation by decree. So they are trying at any cost to make savers, to make investors take more risk, and to sort of put more money into the real economy. So if you, as a central bank, push bond yields to historical lows, the expected outcome is that investors will decide not to be invested in such highly liquid assets and move into sort of long-term real economy type of investments. However, Obviously, that doesn't happen. No, it creates a perverse incentive. So basically, the lower bond yields are, and the higher that valuations of the stock market become, what you see is that investors go where the money is created. So central banks are basically in a sort of catch-22 situation by which they try to push investors and savers to take more risk and to drive the economy to a stronger level by investing in the real economy. But what investors do, obviously, is to increase their exposure to short-term liquid financial assets. At the forefront of it all is the magical idea that by increasing money supply, the transmission mechanism of monetary policy will end up reaching the real economy in some form and driving growth higher, employment higher, and obviously with that inflation.
And also the Swiss National Bank has a sort of program to buy equities as well, right? Can you speak to that in terms of why they're doing that?
Well, you see, one of the problems that central banks face is that when they start these programs, repurchase programs, is that there's a point at which they run out of things to buy. But at the same time, there is a point in which their position is very dangerous, because if they run out of things to buy, and obviously if you run out of things to buy, you basically just stop buying. But if you stop buying, you can create a financial crisis because valuations have gone through the roof. And therefore, they become what I call in my book, in Escape from the Central Bank Trap, the pyromaniac firefighter. Is that they basically have to do more to prevent a crisis happening because of their policy. And therefore, that's why they buy equities, or why they buy corporate bonds of companies that have never had problems in financing themselves. Is because they need to continue to push valuations higher.
And what about the ECB? Do you see the potential for that central bank in buying, for example, German equities because of maybe running out of bunds or certain types of assets in their asset purchase programs? Do you see that possibility?
I mean, the possibility is obviously there. I think that it's a long way ahead, because extremely loose monetary policy is relatively new in the European Union. However, it is extremely likely. Why? Because the European Union and the European Central Bank itself are actually moving in the same direction as Japan did in the late 90s. No? So one of the reasons why I believe that there is a strong possibility that the European Central Bank will move to at some point buy equities is that the same way that it moved from buying toxic or high risk sovereign bonds, it is now in a situation in which it needs to buy high quality corporate bonds. So the problem for the European Central Bank is exactly what I was mentioning, is that they are unable to get into a situation in which they create that level of inflation that they're looking for, and at the same time they run out of options. So the possibility of buying equities is not small. It is actually quite relevant, because if you think about what happened in Japan, it is pretty much the same. It started buying, the Central Bank of Japan started buying exclusively sovereign bonds. Then it moved to corporate bonds, and then as it is doing now, it is buying Japanese equities. So if the European Central Bank, as I believe, finds itself trapped in a similar situation to which the Japanese Central Bank found itself, it will probably also move forward with purchases of equities.
So how long do you think these trends will last for? Like, what is the end game, or will there be continued buying of corporate bonds and equities by central banks?
What is the end game? Unfortunately, as it has always been, and it is no coincidence, it will be a financial crisis. It will be a financial crisis because the excess risk taken will end up, generating a turmoil in financial markets. And central banks have never, ever been able to predict a crisis, let alone see a bubble. So they simply go on. And then just because there is no relevant increase in inflation, they continue to go on. And then when it bursts, then they do it again, which is what we have seen over and over again. If you think about the past crisis, it is always the same pattern. First, central banks try to devalue the currency like there's no tomorrow by issuing as much paper or by increasing money supply as much as they can. Second, they lower rates immensely. That leads investors to take extraordinary levels of risk in financial markets. And when valuations are simply unjustifiable, when those bubbles burst, then central banks lower interest rates again and they increase money supply yet again. Those were the origins of the tech bubble, of the housing bubble, etc., etc., etc. Now, the problem next time is that in the past crisis that we have, that I analyzed in Escape from the Central Bank Trap, there were a number of tools that central banks could actually use, because you could actually lower interest rates from, say, 6 to 5%, or from 5 to 4, etc., etc. The problem is that right now we're living in a world of zero interest rates, and in which the balance sheet of central banks is not small, it is actually very elevated. Hence, the risk of a much more abrupt crisis in the future, because they will run out of options or tools to manage the situation in the way in which they've done in the past.
And do you have any idea on the time frame for that next financial crisis?
Yeah, that is the problem. That is always a problem. Financial crises always happen in assets and in where the general consensus is that there is no risk. The tech bubble happened because everybody believed that we were living in a new paradigm and that technology could not be valued as stocks or as companies the same way that we used to value traditional companies. The housing bubble happened because the vast majority of population thought that house prices could never go down, and therefore, you could leverage your home or your real estate asset as much as you wanted, etc., etc., etc. So, but like those bubbles in the past, they test even the most astute investor and the best analyst, because that's why they're bubbles, is that they take longer to create than what many expect, and when they burst abruptly. If you think about, I don't know if you've been able to read the book or watch The Big Short movie. If you think about it, the guys that predicted the housing bubble, from the moment that they saw the immense bubble that had been created until it actually burst, it was a good 3.5, 4 years. So it is so predicting the time frame is very challenging, particularly when, unlike in those previous financial crises, in this one, on top of it, you have a number of central banks that are working in a sort of coordinated way. So when the Federal Reserve starts to normalize a little bit its monetary policy, Japan, does it a little bit more aggressively. Then when the European Central Bank goes further, the others reduce a little bit. So there is a lot of manipulation coming from the central planners, but the end game is always the same. It has always been the same, and it will not be different this time.
Interesting. And so in terms of the nationalization process, what are the negatives of this to an economy? I guess you can consider central banks picking winners versus not allowing new entrants into the market, like smaller companies, perhaps. Like, is there sort of a hazard of that to the economy, moral hazard? What are your thoughts?
Yeah, that is a good point. At the end of the day, it generates the same negatives as any level of central planning in the economy. It's a decision by a group, by a small group of people, of who and how the winners will be created within the economy. No, but more importantly, I think that the biggest risk is that it does three things. The first thing is that if you're a very leveraged, very a dinosaur type obsolete company, it basically perpetuates obsolescence. It also perpetuates overcapacity, and it gives the impression that there is no risk in areas where there is a lot of risk. So the biggest risk for the economy is that, as we are seeing, by the way, is that despite all this activity, the average citizen, the middle class, etc., fail to see any improvement in their lives, while at the same time, in their disposable income, in their pockets, in their wealth, which is mostly in deposits, they suffer. So the biggest problem is that you're gradually eroding the middle class, which is the most important part of the economy, in order to perpetuate sectors that have access to too much debt and that invest in overcapacity.
Yes, and as you mentioned, the private sector suffers the crowding out effect in crisis times and the taxation and wealth confiscation effect in expansion times.
Exactly. When you see it, and we, in America right now, we have seen it in the particularly in the past 8 years, the largest transfer of wealth from savers to government seen in history. 1.5 trillion of new taxes with an added 10 trillion of new debt and 4.7 trillion of money supply increase. So the average citizen basically is throughout the crisis. It doesn't benefit, and in expansion times, it gets taxed away from the ability to climb the ladder. So everything that we're striving to achieve from the perspective of a family, from the perspective of a normal economy, where you're basically trying to save a little bit for the future so that your children are able to achieve a better standard, and then with that get to a better position in the future. All of those things that created the developed economies are basically subverted, and what governments and central banks are doing is literally taking from the pocket of the middle class and giving it to the sectors that are close to government and the sectors that are close to government.
And as you mentioned, also the public sector comes out from these crises more powerful and more indebted.
Exactly.
So that's yeah.
So from every crisis, the mainstream economists will tell you that it is the public sector that has to spend, it is the public sector that has to borrow. Obviously, the public sector has an incentive to spend on in a manner that is completely different from the private sector. It's not looking at profits; it's looking at maximizing budgets. Then what happens is that obviously the level of growth, the level of jobs, the level of salaries that were expected are not created, but the bill of the mistakes of that investment or that spending are passed to the middle class. So if you start doing that in the 50s, you basically achieve a level of you have some level of I would say cushion in disposable income from families. What you see right now is actually the opposite, is that the ability of families to improve after a crisis is really, really limited.
Well, that's fascinating insight to help our understanding of the macro. Daniel, how can our listeners learn more about your work?
Well, I think that the best way, obviously, is they can follow me on Twitter. I have an international account, which is with all the news and my opinions in English about what's going on. Obviously, my books, Escape from the Central Bank Trap, The Energy World is Flat, and Life in the Financial Markets, in which I mention all these things about what's happening in the financial markets. And in my website is dlacalle.com, so DLACALLE.com.
Great. Thank you very much, Daniel, for being on the program show.
It's been an absolute pleasure, Richard. Thank you so much for having me.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.